Hey everyone, Gary Nims here with Windermere Real Estate and your monthly market update video. Hope you guys are all well. I'm here to show you what's happening in the market. So without further ado, let me share my screen. So one thing that we're seeing here, this is a graph for the last 10 years, and it's a median price, kind of an appreciation graph. So you see we've almost tripled our median price since 2013, July, and this is a snapshot of all of the Julys over the years. So you can see how last year was just a crazy year, and this year started off that way. We've given back some, but we're still up 7%. So that is a good thing. We're entering into a much healthier market than we've been in. The next thing I wanted to show you was a heat map that we have. So this is this year. This is a year ago. This is 2 years ago. Does anybody notice anything a little different about those heat maps? This one's really plain. This one's really plain, unless you like yellow. Now this one right here, we're starting to see some green. Well, what does that mean? We're seeing it on the east side. We're seeing it a little bit in Seattle. We know that the east side far away, pulled away from Seattle in terms of appreciation, especially over the last 2.5 years. They have Seattle has a little less to give back, but Seattle's starting to participate. Just giving back a little bit is a really healthy thing. So what does the green mean? Let me go up to the schedule. That means this is an inventory heat map. So this looks at how much inventory there is versus buyer demand. And a balanced market is about 2 to 4 months of inventory. And so we're starting to see that. Don't see any technical, buyer's market inventory, except there are some price points in this area 520. Let me show you where this is. I'll go over here, area 520, and these areas, they're like realtor zip codes, so to speak. These are areas that have been developed over the years by the MLS, and these areas kind of operate like area 540. It all operates similarly as far as how the housing market goes. 530, the same. That's how these areas are delineated. Well, you got Hunts Point and you got Yarrow and you have Medina and you have Anatai and some of these areas in here. It's some of the most expensive real estate in the country. So some of those are in the 4-month inventory area. But there's certainly some opportunities out there. I'm going to stop sharing my screen and for just a moment. Especially for some folks there's some folks that are more motivated to sell. And so there's this tool that I wanted to share with you guys. It's called a 2-1 buy down. And some of you may have heard of it, but it is a temporary interest rate buy down. So here's how it works. So a seller goes into contract with a buyer, and the seller agrees to provide a credit to the buyer at closing. So why would you do that? Well, there's a strong current thought out there right now that says the Fed is going to raise the rates up too high, and they're going to tip us into recession. And then we'll have lower interest rates again. So why would a buyer use that credit? Maybe not towards their closing costs, but maybe they use it towards this 2-1 buy down. Well, what happens in the Northwest when rates drop, interest rates drop? Buyers start coming out of the woodwork again. It gets really, really competitive. So next thing you know, we're waiving things again like financing contingencies, and we're agreeing to pay the difference between the appraised value and the purchase price. I hope we don't see this again anytime soon, but there's a very real scenario that we could be there again. And there's a scenario where there's a path where it would be in the not too distant future again too. I hope not, but it could happen. But let's just take a really rough example of this 2-1 buy down scenario. As the buyer, you get to use that credit for a 2-1 buy down, and it's not nearly as expensive as a permanent interest rate buy down. And here's what it does. The 2-1 buy down, it reduces your interest rate by 2% the first year. So it reduces your interest rate. That affects your principal and interest payment. And then it reduces, but the next 12-month period, it reduces your interest rate by 1%. And then the third month, and depending on if you have a 15-year loan or a 30-year loan, that's how far it goes out, would just be the market rate. So, so when you do that, you're ready to finance at the lower rate, and perhaps with a little luck, you never end up paying the full interest rate on your payment if you refinance before that 2-year period is up. Let me just share my screen here real quick with you, and I'll give you a kind of a rough example. I'm not a lender. I am a real estate broker. You need to check with your lender for specifics on this. This is just a 30,000-foot view. But let's say you have a 2-1 buy down. I'm going to share my screen. You get this 2-1 buy down. Let's say your loan is $750,000. So let's say your interest rate is 5.75%. Your principal interest payment is going to be somewhere around $43.77. Now, just a note again, I'm not a lender. I'm not quoting any rates, and I'm not including your taxes and insurance or any dues that might be included. That would be a payment burden as well. This is just principal and interest. So $43.77 is about your principal and interest payment, but the first year you're going to pay it at the rate of 3.75% instead of 5.75%. So you're going to have about a $10,000 savings, close to $11,000 savings for that year, and that gives you some payment relief. Now you got a $750,000 loan here at the next, it's 4.75%. And so now your payment is $39.12. And you got about a $5,580 savings. Now the third year, it reverts back to this. Okay. So that is how this tool works. Let me stop sharing with you for a minute. Now, why is this not dangerous? So is this like the interest-only loans that we used to see, or even worse, some of the negative amortization loans that we saw before 2007? So because you have to qualify at the market rate, remember the 5.75%, you had 3.75% and 4.75%. Now you're back to 5.75%. So because you have to qualify for the current market rate, the lender says, well, we know you can afford the highest payment, so you're fine. But you benefit with the lower payment for a couple of years. And then potentially you refinance when the Fed lowers the rates. So some people are saying, marry the house, but date the rate. It's kind of a funny relationship analogy where you buy the house, you're gonna be in the house for a long time. You might be in it for 5 years, 7 years, 12 years. You might be in the house for 30 years. That's great. There's times along the road where it makes sense to refinance. So, hey, there's a lot going on right now. We've seen rates just settle a little bit here. Stocks are looking like they're rebounding a little bit. Is anyone watching that? The market's found its groove a little bit. And so some of my grassroots indicators are lighting up. All of those of you who know me, you know I love statistics and I like to watch trends, and I kind of like to prognosticate and pretend like I'm an analyst. I'm not an economist. I'm not a trained economist. I watch a lot of economists, and I like those things, but I also like grassroots indicators. So I'm talking to lenders. And I know a number of lenders, and they're taking on more applications. There was a real lull for the last 2 months. In the last couple of weeks, I'm hearing my lenders are saying that their application lines are starting to come alive. So that's a good thing. That I'm talking to my stagers, and they're starting to get busier, meaning more inventory is coming on. I'm talking to my photographers who are photographing houses for listings. more listings are coming. So we're starting to see some of that. And you remember when I showed you the heat map? So that heat map is an indicator that we're getting into more of a balanced market. And so sellers might be like, instead of where we've been the last 2 years and essentially the last 8 years, a lot of sellers were saying, well, where do I move? Unless I'm moving outside of the area, I can't make a lateral move, because it's difficult to sell my house and take all the equity out of my house and buy the next one, because nobody will accept a contingent offer, or the bridge loan scenario is not going to work, or I've got to use some kind of a cash buyer program. Now it's breaking up the market just a little bit, and that's helping us a lot. So what I'm seeing, we're finding a groove. Things are coming on in line with what we've traditionally seen in the Northwest. July and August has moved very slow, and that's kind of a trend that we see over the years. July and August tends to slow down in the Northwest because we all see the sun that we haven't seen for 6 or 7 months, and we want to go out and enjoy that. Now I'm starting to see September and October activity pick up. Statistically, we'll see the best inventory over the next 2 months that we're going to see until like March. So buyers, get ready. You're going to have the best selection in September and October, and then you're going to see a lull. And the inventory, you're not going to have as much inventory, most likely in November and December and January and most of February. So if you want to buy, now's the time to get busy. Reach out so we can get our buyer intake meeting scheduled, get you approved for financing. If you're doing financing, let me share my screen with you one last time before we go. My name's Gary Nims. You can reach me at this website here. You can also reach me at the phone number 425-269-8151. And until we chat next, I hope you guys make it a great day. Take care.